Well, it's a new year, and the Watch the Tape YouTube series has a new look and a new dedicated channel. So please hit that subscribe button. All right, let's jump into it. The global stock market is up 42% over the past 2 calendar years. This has undoubtedly been great for investment portfolios. And the wealth effect that comes with that is quite nice for the psyche, I might add. But after such a strong bull market run, I wouldn't blame you if you had a nagging feeling. Maybe you're starting to wonder, is the stock market overdue for a correction, or worse yet, a crash? And if you're on the precipice of retirement, this question becomes all the more important. Can you imagine retiring now, saying goodbye to your salary, and then beginning to withdraw on your portfolio, only to see the stock market crash right out of the gates? You really don't want your investment portfolio to hit a rough patch right as you start withdrawing from it. This concept is known as sequence of returns risk, and I made a video about it last year. I'll include a link in the description below. The assessment of sequence of returns risk is captured in the overall financial planning process. I use Right Capital to customize my clients' retirement plans. It allows us to input any number of assumptions about timelines, incomes, spending plans, and other goals. It's very flexible, and it includes a Monte Carlo analysis, which produces a probability of success. You want this probability to be 80%, ideally higher if you're approaching retirement or are already retired. This type of retirement plan is forward-looking, and frankly, it's the right way to plan. But I had a client recently ask a what if. What if he and his wife had retired at the end of 1999, such that they started withdrawing from their portfolio right as the stock market entered a 3-year losing period? The global stock market declined 41% over that 3-year period. We call that no bueno in the investment biz. For this what if analysis, let's say this client's starting portfolio was $2 million, invested in a 60-40 mix of global stocks and US bonds, and their starting withdrawal rate was 4%. What would be the value of their portfolio today, 25 years later? So I put together a simple spreadsheet that answers the question. We know all the inputs, namely the investment returns from stocks and bonds, as well as inflation, because remember, the 4% withdrawal rate determines the first year withdrawal amount. Then whatever that dollar amount is, it is adjusted upwards each year based upon inflation. So the first year withdrawal would be $80,000. And if inflation in the next year is 2%, it would be $1,600 higher, and so on and so on. The idea being that the purchasing power of your withdrawal is kept at the same level throughout retirement.
Let's go to the spreadsheet.
There is a lot going on here, so bear with me. We'll go from left to right, starting with the years 2000 through 2024. Next, we have the returns for stocks and bonds, which are used to calculate the return on a portfolio of 60% stocks and 40% bonds. Inflation is what we'll use to adjust upward the actual withdrawal amount each period. We have the portfolio values at the beginning of each year, the actual withdrawals taken from the portfolios, the investment returns on the portfolios, and lastly, the portfolio values at the end of each year. And what we're going to be focused on is that figure in the lower right-hand corner at the end of this 25-year period. So with a $2 million starting portfolio in the year 2000 and a 4% withdrawal rate, the ending portfolio value after 25 years would have been nearly $1.8 million. I can't imagine anyone would be disappointed with that, aside from maybe regretting not having spent more in the early years of retirement. But this is tricky and a little risky. I'm going to change the withdrawal rate to 5%. So right now at 4%, the withdrawal amount in the first year is $80,000. I change this withdrawal rate to 5%, and that first year withdrawal becomes $100,000. And the ending portfolio value at the end of this 25-year period is $200,000. So that 1% change in the starting withdrawal rate makes a huge difference in the ending portfolio value. How about a 6% withdrawal rate? That, my friends, would have been far too aggressive, as the portfolio would have been depleted sometime in the year 2019. While this is interesting and illustrates that a 4% withdrawal rate, even if you had started right before the dot-com crash, would have resulted in plenty of portfolio left after 25 years, it is just one piece of the overall assessment. And it does have some assumptions that may not apply to your situation. For one, it doesn't take account of any taxes on dividends or interest collected along the way, or for capital gains taxes from rebalancing to a 60-40 stock bond mix each year. So we're assuming these are all IRA dollars. And it's fairly rigid too. In reality, you'd likely exercise some spending flexibility in the face of declining investment markets. And as you age, your withdrawal rate gradually declines until a point when you may need some additional care later in life. And then lastly, we probably wouldn't keep you in a 60-40 stock bond mix through your entire retirement. But there is beauty in the simplicity of this back test for illustrative purposes. Thanks for watching. Be sure to hit that subscribe button, and I'll see you in February.